Welcome. Okay, I got it now. Welcome to the live local business lunchtime webinar series 2022. I'm Adam Bude from the Authentic Sales Training Academy, and I'm excited to be co-hosting this 6-week live and interactive series with you all on how to not only survive, the potential rough waters that are about to come economically, but how to thrive beyond that. We've put together an expert team of panelists and industry leaders here across multiple sectors in business advisory, banking and finance, sales and marketing. And each week over the next 6 weeks, we're going to be hosting a 20-minute session covering key topics of interest on how to restructure for the future business expansion and growth and success for you and your business. Our panelists that we have is Mr. Matt White from MJW Advisory. Mr.
Hi, guys.
Pardon me?
Hello, guys.
Matt from MJW Advisory. Phil Imroff from Bank of Queensland, Robina branch. Unfortunately, Phil has just come down with COVID today, so he won't be with us physically, but I'm sure he's watching. Glenn Bossy from 2020 Financial Services. Mr. Mark Grant from Costless Payment Solutions.
Hello, everyone.
And as we all know, Mr. Nick Cree from SmashGo, as well as myself. These are going to be short, sharp 20-minute sessions, and at the end of each session, we're going to open up the lines for live Q&A. So make sure, as you see the series of speakers that are coming out over the next few weeks, if there's anyone in particular that you want to connect with, make sure you're absolutely there on that call and you have your questions ready. Today's expert speaker is Matt White, and Matt's the owner and principal of MJW Advisory, a tax and accounting advisory firm based in Queensland. Matt's got over 20 years experience in the professional services industry, and he has a passion for innovation, commercialization, business strategy and growth, succession and exit planning. He's got a deep understanding of the Australian R&D tax and government grants regime, and is an approved export grant quality incentive program consultant under Austrade's EMDG program. Matt holds a Bachelor of Business Accounting and is a member of the Institute of Chartered Accountants Australia and New Zealand. I'm glad that was written down because there was no way I was going to remember all that, Matt, but the floor is yours. How are you going?
Thank you, Adam. Yeah, I was hoping, mate, you might take an abridged version of that background and summary, so sorry to bore everybody, but thank you. Appreciate your attendance. As introduced by Adam, we are accountants in Brisbane and on the Gold Coast. And we've got a fairly broad mix of clients spread throughout the east coast of Australia, and more importantly, across multiple industries such as property, real estate, manufacturing, construction, transport, technology, and agriculture. We also have several clients that either import products from all over the world or export their products and services to parts of Asia, North America, UK, and Europe. So our clients are experiencing firsthand, and I guess indirectly we are, the impacts both locally and globally of those global factors such as increased interest rates, fuel prices, shipping delays, supply price increases, availability of product, and a tight labour market, both domestically and abroad. However, the sentiment that we're experiencing is still one of opportunity and demand. The frustration, however, is not being able to capitalise on the market opportunities due to longer cash flow cycles and retention and attraction of quality staff. These therefore affect the business's capacity to take advantage of these opportunities and grow. So I'm not going to get too accounty on you today, but there are some key areas that I would like to talk about, namely knowing your numbers, what drives them, particularly pricing, review them regularly, and in today's environment, perhaps these should be examined monthly. Secondly, how to attract, retain, incentivize, and engage quality staff. And then thirdly, tax structures and how business should be structured for growth. As Adam said, we are recording this webinar series, so if you'd like a link to today's presentation or any of the discussions over the 6-part lunchtime sessions, please email me at matt@mjwadvisory.com. My email should be just above me. I'm also happy to offer a complimentary strategy session to talk further about each of these topics or any related query that you might have. Okay, so know your numbers. Know your numbers and what drives them. Favorite topic of most accountants, yet ironically, not one that regularly is at the top of an accountant-client meeting agenda, but one that I think is fairly critical. What amazes me is how many businesses solely use their bank account as an indicator of how well their business is tracking. Certainly a good place to start, just because at the end of the month or across a 3-month average, you might have money in the bank, does not mean that your business is generating enough cash to enable it to sustainably grow and scale. It's important to understand what the cost of being a business is, and considering all the stress and risk of being a business, how much profit do we pull out of it? And then beyond that, are we generating sufficient additional funds to enable us to grow? So largely this comes down to price. How do we set a price that incorporates the margin that we need to achieve this? Sounds pretty basic. Price is really just cost plus margin, right? But we really know what the true cost is, and have we strategically set a margin or a margin benchmark after taking in consideration factors that affect the cost of doing business? So very briefly, costs are generally categorized as either fixed or variable costs. I won't go into too much of a deep dive today, but fixed costs are generally our costs of opening the doors and expenses that we're committed to regardless of sales. So these obviously include our rents, our overheads, insurance, IT infrastructure, salary and wages of permanent employees, legal fees, accounting fees, etc. Those variable costs are the cost of purchasing products and materials that go into products or servicing those items that are sold. These are cost of acquisition of product, transport costs, casual staff, contractors, etc. So whilst we factor those things in, or I hope that we factor those things into price, invariably what I find fairly consistently is that we've neglected, when price setting, to incorporate the cost invested in purchasing, maintaining and operating physical assets, time and investment committed to developing procedures, training staff, developing marketing collateral, generating sales leads and conversions, onboarding a client, delivering your service or product to your client, continuing client engagement to keep them on track. Every dollar spent should be considered as an input to the cost of doing business and the price we apply to our product or service. However, once we understand cost, then what margins do we apply? Margins could be a function of the industry that we're in, what product you service and who you're offering your product or service to, the risk factors of the product or service you're offering, what value you're providing to your clients, and what you want to be known for. This is ultimately known as your business model. This is something that I find organically changes shape over time, but ironically is a process that every business owner should go through even before deciding to go into business. A high volume consumables business may be obliged to set a margin as low as 5 to 10%, where volume is a key driver to the business. However, if your business is a service-orientated business that carries large amount of recourse or risk, or you're a provider and manufacturer of a high-end product, value-added offering or product, you may apply a margin of 40 to 60%. So understanding your industry, your competitors, your client, your product, your service, etc., is key to knowing what margin you wish to achieve, whilst also being mindful of what margin will enable you to compensate you for being in business, the risk that you want to take, but then also enable you to grow and scale. Regardless of your model and who your client is, all of these factors need to be regularly reviewed. There are businesses that go through this process yearly and some that haven't gone through the process for years. In today's market, I think a detailed review should be undertaken at least every 6 months, possibly every 2 to 3 months, to ensure that we keep up with the weekly and monthly increase that we're experiencing in interest rate, cost of fuel, cost of groceries, cost of energy, and cost of doing business. prudent, therefore, for this to form a part of your regular discussion with your accountant, and also have communication with your clients. Invariably, your clients are also experiencing increased costs of doing business for themselves. And often we're scared to pass those costs on, yet they should understand those things. And quite frankly, we can't afford to be carrying them, and they can't afford to be carrying you. So regular communication and review of price structure, I think, is critical, and one, unfortunately, that just doesn't happen regularly enough. So secondly, my second focused area is how to attract, retain, incentivize, and engage quality staff. Fairly topical. Currently, Australia is experiencing one of the tightest labour markets in its history. Unemployment is at an all-time low in almost every industry in Australia, particularly those requiring highly trained, highly skilled labour force. We're struggling to keep and struggling to attract key employees and quality recruits. This, of course, is impacting our ability to jump on opportunities, service our clients, scale and grow our business. There are numerous ways to incentivise staff. However, it's no longer enough to simply offer them a market rate of salary. Businesses are offering above market rate, as well as flexible work arrangements, bonuses, education and training, additional leave days, etc., and still getting zero candidates. An alternative to some of the traditional remuneration strategies, and one that we have seen large take up in, is the implementation of employee share ownership plans, or ESOPs. Employee share ownership plans are also known as employee share schemes, employee equity plans, employee option plans, etc. But they're basically just a legal arrangement whereby business allows its employees to own equity in their business. They're offered to encourage employees to think and act like owners, unlike bonuses and incentives and commissions, which are often discretionary and often only provide short-term incentives. ESOPs are a mechanism to retain staff long-term. They can also help maximise the business value for the owner. Should the owner look to sell, they can also be a mechanism for the owner to gradually sell all of the business to employees, known as a management buyout. You may never be able to lock an employee into the business for life, and there are numerous factors beyond working in your business as to why they may choose to leave, such as moving interstate, taking a lifestyle change, winning the lotto, whatever. However, there are various ways to structure an ESOP to reward for long-term tenure. For example, they can be offered additional shares at certain points in time, should they stay employed over a long-term period. They can be structured whereby they have preferential dividends paid subject to performance. They can also be structured to ensure longevity, where clauses can be put in place that only crystallise after a minimum holding period, whereby they can receive the distribution or the benefit of having equity in the business. But the crystallisation might take, or may only crystallise over a 5 or 10 year period, just by way of holding out the carrot to enable them to stay within your business. They don't mean that an employee is locked into business for life should they turn into a problematic employee. We probably wouldn't offer them equity in the business if they were problematic to start with, but life changes and business changes. Sometimes people are set in their ways. So you can actually incorporate rules for exiting employees and rules for exiting bad employees, where benefits are forfeited should they leave due to dismissal, breach of employment contracts, etc. From a tax point of view, they can be FBT free for the business owner, and also tax deferred for the employee, depending on the structure of the employee share ownership plan. Typically, an employer is taxed on each disposal of shares that they sell, but depending on their situation, they'll likely be able to take up the advantage of small business CGT exemptions. Like anything, there is a cost, obviously, of setting up an employee share ownership plan, and one which requires a business valuation. However, once set up and in place, ongoing administration is reasonably low, and introducing new employees once the structure in place is certainly easier. However, you need to balance this against the cost of recruitment, the cost of training, the cost of staff getting up to speed, the cost of replacing staff when people leave. So the cost of establishment and maintaining an ESOP is probably minimal, given recruiter fees and the low productivity you get out of staff on onboarding them. And then, as discussed, having key employees in an employee share ownership plan can help increase the value of your business should you wish to sell, certainly by reducing, one of the key risks of any buyer who looks to purchase your business, which is people risk. If I am to purchase your business, do I have the staff? Do I have the people that are highly trained in order to operate this business as a going concern from day one? So finally, I want to get to the tax side, tax structures and the importance of generating taxable profit in a tax-effective structure. So what I try to focus on today is how price with sufficient margin can enable sustainable growth, as well as how to attract key employees to support that growth. However, often this has come unstuck where businesses don't understand how and why paying tax in a tax-effective structure can enable you to build a war chest of cash to enable you to grow. So certainly my comments may be subjective. I'm sure that there are other accountants in the room that may disagree. But if you have an ongoing, I don't want to pay tax objective, you're doing your business a disservice and often damage. How often do you really need to buy a new dual cab ute? How often do you really need to bring forward the renewal of plant equipment? I'm not saying you don't need to maximise super contributions. I'm not saying that you don't need to update infrastructure and plant and assets as these get old, but do you really need to buy a new vehicle every year? And if it's simply to absorb profits to take up a tax advantage, it's probably because you're not structured correctly. So understanding tax structures is usually the domain of the accountant solicitor, and our eyes invariably gloss over that discussion. But it's not that hard to understand. And certainly if you're paying tax in a tax-effective structure, it means that you've got more retained profits in the business, and any tax you pay ultimately comes back to you in a fully franked dividend anyway. Name of the game to capitalise on opportunities in the market is to be able to afford them, and you can't afford them without surplus and retained profits in your business. So Structures 101, sole traders, for those of you that are operating as a sole trader, very, very little accounts can do to help you, meaning all the income that you've earned as a sole trader under an ABN is going to be attributed to you. Sure, you can employ employees in that structure, but any profits of the business can't be retained. You're ultimately left to be taxed at the marginal tax rate. And if you've got super profits, you're going to be taxed at 48+%. They're also the most risky structure. Whilst there's minimal tax planning that can be undertaken to help reduce the tax burden, probably most importantly as well, if you're operating as a sole trader, your personal assets are exposed. So in the beginning, when we may be consultants or we may be starting out, a sole trader might be one that you choose to take up. I wouldn't think so. It doesn't cost that much to set up other structures. And ultimately, it's saving two things, your risk of doing business. And then secondly, when profits come into the business, they're not taxed at the highest marginal tax rates. So trusts, operating in a trust with corporate trustees and companies might seemingly be more complex, but have a much greater flexibility to retain profits, objective retain profit, build up the war chest. You need profits to enable to grow and scale at a sustainable rate. Finally, sure, we pay tax in a company at a corporate tax rate of 25% or something like that. But understand how that works as well. When you pay tax in a company, you get ultimately what's called a franking credit, which is the credit for the tax paid in a company that then is available to shareholders. And then eventually when shareholders pay a fully franked dividend, you get your tax back anyway. So once again, adopting a policy of I don't want to pay tax, going out and buying the wife or updating your ute every single year to absorb your profit, So you save tax, I think, is really detrimental, and certainly not one that enables you to retain profit and grow. So I think I've come to the end of my time, Adam. We do have some available or time available for questions. I'll leave it to you, Adam, to facilitate that. Thank you.
Fantastic, Matt. Thanks so much. You raised some really good topics there, and I'm really excited to hear an accountant talking about talking about employee share schemes, because I speak a lot about that when I'm talking to businesses. How do we engage your sales staff? Don't just treat them like a staff member that's disposable and have these little commissions that you move the goalposts on all the time, and but actually have skin in the game, have them want to show up and have them want to invest more in the business because they feel like they're part of the business. I see that as a huge way forward for a lot of business owners. So that was really good that you brought that up today.
Yeah, and certainly employee share ownership plans are huge throughout the United States, and probably even more so in the UK. But they are starting to get higher take up in Australia, and certainly for that reason. Often we get really great doers of the business. They don't necessarily want to be the face of the business, but they'd like to at least be rewarded for the work that they're doing beyond their salary. So those mechanisms are certainly becoming more and more popular.
Absolutely. So guys, if you have questions, unmute yourselves.
Can I just say one thing, Adam? We're lucky today. We've got Kelly that joined us today. She's in recruitment. So this whole employee staffing, I'm sure Kelly can help us as well.
Yeah, and certainly I think, and Kelly's welcome to that comment, attracting, retaining staff is pretty critical, but it also needs to align with values, and it's not the only input that goes into why you'd want to attract staff and why you would be an attractive business for staff to come in. We obviously don't have the time for that, and I think some of the other speakers may speak about that over our 6-week period, but it was just one of the points in my areas of discussion today.
Yeah, I found it interesting. Great information, Matt. From me as a recruiter, I concur with what you're saying. I mean, the labour market is so tight right now, and a lot of our resources are being spent on finding candidates, not advertising for candidates. So for any business out there, if you're putting an advert on Seek, etc., I mean, the job boards are just going up and up and up. Like last week, for example, there were 3,000 new jobs in trades alone. And, people just can't find staff for love nor money. The way we're finding staff, 68% of our staff now come, or the people that we place into employers, come from sourcing. So we're manually sourcing, headhunting, finding candidates ourselves. So advertising is just not pulling in enough people at the minute. 27% are coming from adverts alone. So our job is very, very busy right now.
And I think certainly in the professions and the skilled labour market, you get to a certain level of experience where you can command a salary of a certain point anywhere.
Yeah.
So why should I come and work for you? What values, what sorts of policies will enable me to come and want to spend the time with you, given that I can get that money on the market with your competitor down the road?
Yeah, absolutely. And it does come down to the person as well, because there are, different people who, it's not about the money. It's about the people that work there. It's about the job. It's about the opportunity. So even the things that you're talking about don't matter, but it just depends on the person,
Yeah. And then even more so than that, one of the biggest things that we see when business owners try to exit is by the time they're 60, 65, they build up a business value. Those people that may have interest in the business just don't have the capacity financially to buy 100% or a large chunk of equity of the business, because they're committed to private school fees for their children. They've got mortgages, they've got personal expenses as well. So an employee share ownership plan may be a mechanism to gradually sell down more and more equity in a business. And that way, then it's more palatable on a bite-sized chunk rather than, you know, that large financial burden of having to finance a $2 million business sale, for example. Yeah.
Great way to structure an exit plan too. Really good way to do it. Anyone else got any questions for Matt? G'day, Paul. Unmute yourself, mate.
Sure, that, yeah. Thanks, Adam. Thanks, Mike. Matt, I was intrigued by your take on, as a sole trader, just bleeding the profits to buy a new ute or something like that. Long time since I bought a car. It will be a long time before I buy another one yet, but I do have a bit of a passion for keeping up with the technology. In the case of cameras, mind you, my big bloke that I'm using down here is in for repairs for $800 after knocking it over the other day. Thankfully, I did buy a couple of new cameras in June, which replaced the little guy up here. So yeah, I saved probably nearly $1,000 by buying them at that time of year, end of financial year. The sales that were on, they're just exactly what I wanted, not as expensive as my big camera, but 5 or 6 years up the scale in technology, which gives me an edge for the coming years. And now I'm even thinking about changing my big bloke for another 1 or 2 of those. That seemed like a decent thing to do.
Paul, I'm always an advocate for a purchase of capital where there's a need. Purchase of capital where there's a need. So if it gives you the capacity to give you a technology advantage or a throughput advantage or a capacity advantage, fantastic. But just understand, do we actually really need this? You know, like there are businesses out there that update the ute every 3 years. You know, update plant and equipment simply to take advantage of absorbing some of the profits in their business. And if that's your plan and that's your strategy, you know, you know, I walk around and I see Toyota Land Cruisers that are, you know, built in 1970s, still going strong. You know, do we need to really update them all the time? Aim of the game for me is to try and retain profit and cash in the business to enable us to scale and grow. So that's my comment. If there's a need, sure, you don't have to put that argument forward. But if it's simply a tax mitigation issue, you're probably not structured correctly for tax. Yeah.
And my 2009 Commodore is still going well, and since you can't buy one anymore, that'll probably.
That's a collector's model now, Paul. I think what you're talking about there, Matt, is strategic investment into your business versus emotionally buying just for the sake of it. And if you're buying out of the money that you pay yourself as a business owner versus just bleeding the business dry, then that's probably a different way to go about it.
Yeah, and I think too, by the way, you know, there's, I see it at both ends. Along the way, you know, we don't want to pay tax, we don't want to pay tax, we don't want to pay tax. And then all of a sudden you come to your accountant and say, want to sell the business tomorrow, but we've got a history of, you know, bleeding, I guess was the word that was used by Paul, bleeding the P&L over the last 10 years. And now you want to maximize your profits. So strategic purchases, absolutely. You know, how regularly do we need to upgrade the ute is probably something I say all the time. So strategic purpose for strategic reasons. Yep. If you're in the correct tax structure, it shouldn't matter that you pay 25%. You're going to get it back anyway, right? So.
Yeah, and I can validate what you're saying there, Matt, because when I was working as a business broker, being presented all the P&Ls to take to prospective buyers, those businesses have been marked right down on those P&Ls. So the actual attractiveness of the business is nowhere near what's represented. And you can't tell someone that, yes, but the business is doing X when actually what you're representing is Y.
Yeah.
So It's a big
And
thing.
finally, and I don't want to get off topic too much, but valuation and add backs that go into value is very, very subjective, right? So you're going to get 4 accountants and 4 solicitors all look at the same set of books, and all of them will subjectively come up with a different value, and none of them are wrong, right? So for me, it's what's in front of me and it's what's presented. But as I said, the ambition should be about retaining additional and surplus cash to enable you to scale, to enable you to invest in the sales academy, or enable you to invest in more staff, to enable you to invest in infrastructure to help you grow your business.
Awesome. Fantastic, Matt. Well, I hope you guys got some great value out of Matt's shares today. This will absolutely be recorded, and we'll be sending out the recording. So you're very welcome to distribute this amongst your networks. And we'll be on again this time for the next 5 consecutive weeks, every Thursday at 12 o'clock. Next week, we've actually got, fingers crossed, Phil will be back on his feet. He's, as I said, got knocked down by COVID, but Phil Imhoff from Bank of Queensland, Robina branch, and Phil's topics that he's going to be discussing will be know your business figures and the reasons for variations and fluctuations, the 5 C's of credit that lenders are looking for, and why banks will structure loans in the ways that they do in order to get them approved. So when you're looking at refinancing and restructuring, to understand what goes on in the back end, so it makes it easier to present to your finances. Like I said, Glenn here is a financer, so he's going to want to know all this stuff up front so that you can hand that to them so we can get it all ticked off for you. So with that, guys, very grateful that you've spent some of your lunch break with us today. And if there isn't any other further questions, this will be a wrap, and we'll see you all next Thursday.